Let's just get going and talk about what we're going to cover today. All right. We're only going to cover five different ideas today, four different ideas. We're going to cover trend, we're going to cover range, we're going to cover price relationships, what we call an A to B, C to D relationship, and then we're going to cover basic beginning of Elliott wave. In the future, we're going to expand on Elliott wave. We're going to look at lots of charts in Elliott wave, and then we're going to expand from that into harmonics. And harmonics are basically patterns that were discovered by a gentleman, Bryce Gilmore. There was Larry Presavento. There was some of the players out there, Scott Carney. They do a lot with both market geometry and these patterns. So the first one that was out there was called the Gartley pattern. And if you guys remember, a couple of months ago, we were doing that Wednesday webinar, and I drew out the Gartley pattern. Well, that's what that is. That was the first one that was developed. And then from that point, gentleman Scott, his name is Scott Carney, and I know him through the Market Technicians Association and the Association of Technical Analysis, and we've met on many occasions. And he's just a real good guy, real smart, and he's put together a book on market harmonics, butterfly patterns, bat patterns, crab patterns, and I even still to this day I look at his work, and you're always learning something. So one thing's important in the markets: always just seek to always learn. I've always looked at different big industry leaders in the markets. Always to this day, I've always learned because you could always learn something, and you never stop it with the markets. That's the great thing about it. So let's talk about what is a trend. Okay, a trend is very simple. Let me just get my ink right here and get my little felt tip pen. Okay, there we go. All right, what is a trend? Most important, bottom line foundation of technical analysis: what is a trend? A trend, basically, as it says here, an uptrend is a series of higher highs and higher lows. What does that mean? Well, if we have a low here and the market went from, say, 100 to 110 and then down to 105, you had a low, a high, and then if it went from 105 to 115, you have a higher low right here. So essentially what the process is once you start developing these higher highs and higher lows, that starts establishing a trend. Now, if the market was going down in a downtrend, and then you have this occur, that doesn't necessarily mean that that's a trend up. That could be a correction in a trend down. What would establish the trend to turn from down to up? We would need to see the market come down again and then up again, where you would start establishing multiple high, higher low, higher high, higher low, higher high, and that would start establishing a trend. So depending, if you're looking at the market from zero, you have to also look at the past and what the past data is telling you. And in this example right here, this example, it's telling you that the market was going down and that you're getting that, starting to get that process of the low, the high, the higher low, the higher high, higher low. And as that continues, you're establishing a trend. So, and this continues to create these higher lows. So this is a series of higher highs and higher lows, and that defines an uptrend. Conversely, a downtrend, you have your high, your low, your lower high, and your lower low, or LL, lower low and lower high. So what you're doing is you're establishing a trend down or a downtrend. Now, typically when you're looking at a trend, the lower high does not exceed the prior lower high. And each low goes below the prior low, as you see here. So when the market makes a low and then comes up and makes a lower high and then makes a lower low, it needs to trade below that first swing low to start establishing continuation of that trend and establishing the trend. Now when the market does retrace up, it has to stay below this low and then continue to make new lows. So you're establishing what we call a downtrend. So uptrend and downtrend. Now, later on, and in other webinars, we'll discuss Elliott wave, we'll discuss the components of Elliott wave, and that is really one of the foundations. If we look back at the old technical analysis, it all started with the Dow theory, okay? Dow, and that's a D, not a P. Dow theory, Theory. And basically the Dow theory said that a series of higher highs, higher lows, and lower highs, lower lows to establish a trend, and that the market should retrace a certain amount. But Elliott came in later on and started putting numbers and retracements and levels and zones and put structure around this theory. So this right here is a foundation of technical analysis. If you understand uptrend and you understand downtrend, you're ahead of the game. Now let me just erase all ink and put the felt tip. Now looking into the future of what we're going to be doing, not really today, but what we're going to be doing is a couple of things. Number one, we always look at this is the move up, and this right here is the retracement. Actually, let me fix the color. All right, let me fix the color here so we have a nicer color. What about that color? There we go. So here we go. So you have your low, you have your high, and then you have your higher low. This right here is called a retracement. Retracement, or it's called a pullback, PB, pullback. So if you hear the term when you're out in the market, because let's face it, we're in iMarkets Live. What do we do at iMarkets Live? We teach people how to make money in the markets. That's essentially the vision. That's essentially what we do, is we educate people how to make money. Yes, we have the signals, but what you do when you're speaking to somebody else, you also tell them that you're an educator. So if they ask you questions, at least you're going to have an idea of how to have a conversation if that person's market savvy. So we look right here, and this is a retracement. And that's what traders basically look for, the retracement. It's every trader in the planet, that's what they look for. They look for the retracement. Once they find the retracement, they look to take a trade. We did that this afternoon. We took a trade. We took one trade, it broke even. We took another trade, and it made a little profit. But essentially, we look for retracements. So these right here are retracements in a trend. Same thing as the bounces you see here in a downtrend. These are also retracements. Okay? And that's what we typically look at. So that is your trend, up and down. Let's take a look at another chart, and let's start identifying some of these trends. Okay, so we established the fact, if you look here, that this market was going up. Should I get rid of the red because now we have red all over the screen? Yes, I think so. Let's take a look and go with blue. So the prior move up was in an uptrend, as you see here, You had a low, you had a high, you had a higher low. So we don't know exactly really what the data was in the past, but establishing the fact that this would be the high, and that would be a low, and then that would be a lower high, and that would be a lower low, and that would be a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, higher low. So what ends up happening is the process probably went something like this. So your trend stopped going down once the higher low was in and started shifting directions back up. Okay, but during the course of this move from high to low, the first thing a trader does is look for the pullback. And you got your lower high, and they look for the pullback, and they look for the continuation. They then look for the pullback, then the continuation, then the pullback, and the continuation. So sometimes pullbacks are pretty, and sometimes they're not so pretty. And sometimes they're simple, and sometimes they're complex. Okay, this would be considered a complex pullback. This is basically a simple. A simple pullback would be here's a move down, and here's your pullback, your retracement in a trend. That's a simple one. A complex one would be here's a downtrend, here's a bounce, here's a failed test to try to make a new low, here's a bounce, and then a continuation. So this is a complex, and this is a simple. And this right here has to do with that Elliott, and so does this. Essentially, and the Dow theory. So if you look here, that is exactly the same. That's a complex retracement as opposed to this one. So two types of retracements, and that would establish this is what a downtrend looks like. High to low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and continue down. And then the process of changing from downtrend going back up, you would have a low, and that should make a lower high, right? Because you're still expecting this to come lower, but it puts a higher low and starts the process up, and then the next move down, and then you're starting that trend going from down to up. Okay, just like you saw here, same process. So sometimes it's pretty, sometimes it's not so pretty. But at least we understand what a trend, a downtrend in this particular instance looks like. Next. Okay. Now, an uptrend. What is an uptrend? Well, this may have come from down here, so if we say that this is a low, and this is a high, and this is a higher low, and this is a higher high, and higher high, higher low, higher high, higher low, higher high, and this is establishing that uptrend process. And that's what's happening actually right now with the markets, because this is current day market right here. It actually went and tested way up here already. Or it did that. Okay. So looking at the complex as opposed to the simple, let's just look at that again. All right. Here is a complex wave where you have your high, and then you have a process like that where the market doesn't just come down and go up, it comes up and then down again and then up again. And sometimes you see the same process like this, and you could see that. You're just following the structure of the market. But as long as new highs are made on every advance and higher lows on every decline, that's establishing an uptrend. And here's these little complex waves is what we were looking at right here. And you can see that happens a lot in the market. It happens an awful lot, which is actually good for traders. We like to see those patterns. So that's establishing an uptrend, and that's what the market looks like. That is the S&P E-mini futures. Let's take a look at the next chart. The S&P E-mini futures again, and this is going back several years ago. So I was just picking some stuff out just to point it out. But let's think. Let's see what we got. We have a low. We have a high. We have a higher low. Higher high. Higher low. And you could just see the continual advance of new highs on every push up and the higher lows on every push down. So what we're doing is establishing an uptrend, and traders like to what? Buy the retracements. They like to trade the retracements because that's where all the money is. It's buying the retracements. All right, and this was written about 100 years ago. All right, and here's another one. Although it still made higher highs and came down, it still was above that prior low, so that remained and kept that trend intact. Right, so the retracements come in different ways. They look at different. For instance, here's a little complex wave as opposed to this one, but the fact is it's maintaining that trend, those higher highs and higher lows. Okay, that's considered an uptrend. We're still looking at that. Let's look at another one. I just want to go through each item: trend, range, price action, and then we'll look at Elliott, and then we'll have you initial structure to work with, so that way next week when we come back you'll have an idea what we did this week, and then next week we can review what we did this week a little bit and apply to what we're going to do going forward. So let's look at an uptrend again. And to be honest with you, a vast majority of the people in the markets don't understand that that's up and that's down. The only difference is you have those little waves in there, which it makes it an up and down trend. But a lot of people don't even understand this basic concept, and it's the most important concept in trading. So here's your low, here's your high, here's your higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So that's establishing what we call an uptrend on that particular chart. In this example, there's a complex wave. And the reason I mention them is because we're going to have them in the future, and I'm going to